In less than 2 weeks, GameStop's stock spiked from $101.74 on the last trading day in February to close between $260 and $265 on March 10 to 12. It did pull back over $44 on Monday to close at $220.14, still more than double from its end of February price. One of the reasons for the move last week was the company announcing its board of directors has formed a strategic planning and capital allocation committee to identify initiatives that can further accelerate the company's transformation. The committee is comprised of Alan Attal, Ryan Cohen, and Kurt Wolf, with Mr. Cohen serving as chairperson. Cohen is the activist investor who joined the board in January and is leading the charge to make GameStop more of an e-commerce company. GME is a highly volatile stock after a peak close of $347.51 on January 27 and an intraday high of $483 the following day. It only took 3 days for the stock to close at $90, down 74% and 81%, respectively. And only another 2 days to close at $53.50, down 85% from the peak close and down 89% from the peak intraday high. Keep in mind that last Wednesday the stock closed up just over $18 to $265 but traded between $172 and $348.50 during the day. It is highly unusual for a stock to drop over 50% during a single trading session and then recover the loss when there isn't any fundamental news on the company. If one isn't prepared for this type of activity, which can lead to large losses, don't buy it. Short squeeze is a minor, if any, player recently while the Reddit crowd helped to create a short squeeze on the shares in late January, leading the stock to reach $483 intraday and close at an all-time high of $347.51. The recent increase is probably not due to short positions being covered. Ihor Dusaniwsky, managing director at Predictive Analytics, estimates how much short interest there is in a stock on a daily basis. His analysis shows that the first big run-up in the shares in late January, early February essentially forced the shorts to cover and dramatically reduce their positions. At the beginning of the year the stock was under $19, right axis, green line in the chart below, and Dusaniwsky estimates that there were over 70 million shares shorted, left axis, orange line. Since there were 69.7 million shares outstanding as of December 1 last year, there was a power keg ready to blow on the stock. In late February his analysis shows that there were about 15 million shares shorted before the stock started its recent rise. With 25 million or more shares traded almost every day since February 24, the start of the recent run, it doesn't appear that short covering has been a major driver. The fundamental numbers still don't make sense. Before COVID-19 derailed the US and worldwide economies, GameStop was slowly losing revenue from fiscal 2017 to 2019, then had a sharp drop-off in fiscal 2020. GameStop may be able to shake up its business enough to recover at least some of downturn, but it won't happen overnight.